All right, before I expose the mortgage and real estate industry, if you already own your home outright, or if you're already looking to put 20% or more down, or if you're looking to stay in the home you're looking to get for more than 10 years, then this video might not apply to you. But still, for the majority of us, for the rest of us, I promise you, if you stick around to the end, you'll have a much deeper understanding, and you're going to ask yourself the same question: how and why is this still even allowed? Imagine this, it's the 1930s. America was going through one of its toughest economic chapters, the Great Depression. Families were losing their homes, jobs were scarce, and owning a house felt like a distant dream. So the government stepped in and created a new kind of loan, the 30-year fixed mortgage. That one change gave people real hope, and it made home ownership possible for the everyday American. Fast forward to today, and while we've made a lot of progress, many buyers are still stepping into a risky situation. Down payment assistance programs offering 100% financing, which sounds great, but let's be real for a second. Starting with little to no equity at all can be dangerous, and it's kind of giving me deja vu vibes if you really think about it. Yeah, no. Right now, I want to show you how our current mortgage system quietly traps people into debt, and how an equity-first mortgage could help rewrite those rules for good. Imagine a $100,000 mortgage with a 6.25% interest rate. Your payment comes out to about $615. Sounds reasonable, right? The truth is, in the early years of that loan, nearly every dollar you pay goes towards paying the interest and not towards owning your home. This chart shows it clearly. For the first 5 to 10 years, your equity barely moves. It's like renting from the bank. You're paying on time every month, but you're not really owning your home. So who actually benefits from this setup? The simple answer really is the banks and the lenders. This system was designed to make sure they get paid first, and that's exactly what happens. It's a system built for profit and not for protection. Remember 2008, millions of homeowners lost everything, and many of them hadn't even built real equity even after years of payments. This chart gives you a clear picture. When people don't have equity, they walk away. Not because they want to, but because there's nothing left to lose. What if we kept the same loan terms, the same rate, the same amount, but changed how the interest is paid? Instead of loading up the interest up front, we spread it out evenly over the life of the loan. And now with that one change, looking at this chart, with an equity first mortgage, you build thousands more in equity in just the first few years. We ran the numbers on a $100,000 loan, and in just 7 years, you'd have over $13,000 more in equity compared to a traditional mortgage. Now let's talk about down payments. A lot of people think they have to save up 20%, or they use down payment assistance programs to skip it altogether. This chart shows something very powerful. With an equity first mortgage, even a 5% down payment builds solid equity quickly. Look, you don't need a huge lump sum. What you need is a loan that doesn't work against you from the start. Now, why does all this matter so much? Because equity is protection. Equity gives you options when life changes: job loss, medical bills, divorce, or even when home prices drop. The more equity you have early on, the less likely you are to default. That's not theory. That's backed by real studies from the Federal Reserve and top economists. Bottom line, homeownership without equity is just long-term renting. We fixed the mortgage system once back in the 1930s. Now it's time to do it again. And while not all down payment assistance programs are all bad, starting with no equity is risky. If you're still considering a down payment assistance programs, because I get it, you don't want to put all your money or all your eggs in one basket. You want to have the money for other investments. Then just make sure that you shop around for the best terms, or feel free to reach out. I'm Robert, and I'll be available. Comment down below what you think about this, if it's even something that we should do. I'll catch you guys on the next one. Thank you.